All right, let's talk about one of the biggest debates in all of finance. Active versus passive investing. I mean, should you be in there handpicking every single investment, trying to find that diamond in the rough, or should you just kind of set it and forget it? We're going to look at this whole thing through a couple of amazing stories, a massive high-stakes bet, and the real-life journey of a guy who totally crushed it.
Okay, so let's get right into it. This wasn't just some friendly wager between buddies. No way. This was a $1 million bet made in public specifically to prove a huge point about how Wall Street really works and, whether those super highly paid experts are actually worth all that money they charge. And the man who threw down this gauntlet, well, it's none other than Warren Buffett. He basically put out this open challenge to the entire hedge fund industry, saying, hey, you guys charge these insane fees for what exactly? For performance that's not so great.
So here's how it worked, and it's actually super simple. The bet kicked off in 2008. Buffett put his money on a single, super cheap S&P 500 index fund. On the other side, you had Protégé Partners, a company that invests in hedge funds, and they got to pick a whole portfolio of what they considered the best funds out there. I mean, this was the ultimate showdown, a simple, cheap, passive fund against the supposed best and brightest minds in the game.
So, after 10 years, who won? It wasn't even close. I mean, just look at the gap on this chart. Buffett's simple little index fund grew by more than $850,000. And those hand-picked, expert-managed hedge funds, they only gained $220,000. It was an absolute wipeout for passive investing.
And this is where Buffett really drives his point home. He wasn't just talking about his one little bet. He said this was a massive, systemic problem. He basically calculated that over that decade, investors had thrown away, get this, over $100 billion by paying crazy high fees for performance that couldn't even beat the market average.
So this huge win for Buffett leads us right into the whole philosophy behind it all. It's a strategy people often call lazy investing, but as we just saw, it can be incredibly powerful. A lazy portfolio, I mean, the name says it all, right? It's exactly what it sounds like. You put together a really simple mix of investments, usually just a few index funds, and then you pretty much just leave it alone. The whole idea is to capture the overall growth of the market in the long run, without trying to be a genius and outsmart everybody, and, maybe most importantly, without paying a ton in fees.
And look, Buffett's bet, it wasn't just a lucky one-off. The data backs him up in a big way. This here is from S&P's own research. Basically, they compare active fund managers to their benchmarks. And what you're seeing is the percentage of U.S. large-cap funds that did worse than the S&P 500 over 15 years. The results are, well, they're kind of staggering.
Yeah, just let that number sit there for a second. Over 93%. That's how many professional, highly paid money managers fail to do the one job they're paid to do. Beat the average. Think about that. Over a 15-year stretch, if you had just bought a boring old S&P 500 index fund, you would have done better than almost all of them. Okay, so the evidence looks absolutely crushing, doesn't it? With odds like that, you have to wonder, why would anyone even try to be an active investor? Well, this is where our story takes a really interesting turn. Because, while those stats are pretty intimidating, they don't tell the whole story. So now let's look at an individual investor, a regular person who took that active road and found some pretty incredible success. So let me introduce you to someone. This is Mario Mendoza. He's not some Wall Street genius. He spent his career as an individual contributor at tech companies. He came to the U.S. 30 years ago with next to nothing, and he just retired, all thanks to the success he had actively managing his own money. And the proof is right here in the numbers. This shows his 10-year average annual return next to the S&P 500. Now, the index did great, almost 15%. But Mario, he pulled in an incredible 20.5% a year. He didn't just beat the market, he absolutely crushed it. He's living proof that it can be done. So the big question is, how on earth did he do it? Well, Mendoza breaks down his 30-year journey into 4 clear stages, and it's actually a fantastic roadmap for anyone who wants to really take control of their finances. He calls it the personal finance quadrant. It's a journey. You start out as a starter, then you grow into a saver, you become an investor, and finally you graduate to an allocator. It's a progression, not just of how much money you have, but of how sophisticated you are with it. So let's walk this path. The starter stage is just about getting in the game. You just have to begin and start learning. Then, as a saver, you build momentum. You automate your savings and focus on growing your income by investing in yourself and your skills. Now, the investor stage, this is the critical part for active success. This is where Mario took full control, building his own accounts, and really honing his own stock-picking strategy. This wasn't about gambling or day trading. It was about doing deep research on companies he truly understood, having the guts to hold on when things got rocky, and always focusing on long-term value. Then finally, as an allocator, your view zooms out. You're managing the whole portfolio, thinking about diversification and being smart about taxes.
So this brings us right back to the heart of the whole debate. We've got one story that says passive investing is the only smart choice, and another that proves active investing can work spectacularly. So which one is right? Well, the answer might not be about getting the absolute highest return possible. It might be about something way more personal: peace of mind.
And here's the thing that might just blow your mind. Warren Buffett, maybe the greatest active investor in history, has given instructions that the money he leaves for his wife should be put almost entirely into a passive S&P 500 index fund. So wait a minute, why? Why wouldn't he want her to own his own company or hire another expert to manage it?
And here's his reason. It's so simple and powerful. His goal for her isn't to squeeze every last penny of profit out of the market. It's just to make sure that money is never, ever a source of stress. A simple, boring, diversified index fund gives a level of security that just eliminates worry. And for him, for her, that's worth more than any potential extra gains.
So what this all really boils down to is that there is no magic, one-size-fits-all answer here. The right path for you depends completely on you. What are your goals? How much risk can you really handle without panicking? And, maybe most importantly, how much time and genuine interest do you have in doing all this research? The answer is going to be different for every single one of us.
Ultimately, it really comes down to this classic story, doesn't it? You have to ask yourself, are you the slow and steady tortoise, perfectly happy to just keep pace with the market's reliable long-term growth? Or are you the hare, actively looking for those chances to race ahead, fully accepting all the extra risks that come with it? There's no right or wrong answer. There's only the answer that's right for you.